Let's find out what our guest host is advising his clients. Steve Davies of Javelin Wealth Management is our guest host for the full program. So,
hi, Chloe.
As investors have gone yield mad worldwide, what are you telling your clients right now?
Well, I think it's actually surprisingly simple. We have to accept the fact that there's going to be greater degrees of volatility this year around a whole series of different events, not least of which is whether or not the Fed will actually increase interest rates this year. But in terms of actual returns, there really is only one asset class to look for, and in my view that remains equity markets, and most particularly led by the United States and to a lesser extent out here in Asia.
So the equity markets were on fire this week, but then again, a little bit of investor nerves frayed by this Greek debt brinkmanship. Their bailout expires at the end of the month. How concerned that this is going to shake investor confidence, like what we saw at the height of the crisis, the previous crisis in 2012?
Well, I think back in 2012, circumstances were very different. This time around, I think the European authorities have been more successful in containing the Greek contagion. And as a consequence, I think that even if we were looking at the unthinkable, which might be some form of exit or restructuring of Greece's membership of the Euro or of the EU, that the impact would be less severe than it would have been even a couple of years ago. Having said that, I think that there are signs elsewhere in the Eurozone that some aspects of the restructuring programs have been reasonably successful, notably in Ireland and Portugal. So it does sort of show that with a little bit of application and determination that countries can and do force the pace of restructuring, which notably at present the Greeks have been somewhat more reluctant to do.
So you believe that all will sail through at the end of the day, in light of the fact that there seems to be increasing worries that the risk of Greece dropping out actually higher than a couple of years ago?
Yeah, I mean, I think that one's got to try and dissociate oneself from all the rhetoric. Obviously, prior to the election, the various Greek political parties were all positioning themselves to try and seem incredibly tough. But the reality is that Greece is in an unwinnable position. If they were to exit from the euro, then obviously that calls into question the entire survival of the Greek banking system. You would have to go back to the drachma, which, regardless of the level at which they begin, would depreciate rapidly in the immediate days thereafter. So Greece would be compounding the severe problems that it already has, and I think that the new government is probably rapidly coming around to that understanding, if they didn't already, but prior to the election result being announced.
And just very quickly, how much can Asia, even Asian fixed income, provide some shield for investors looking for that yield? I mean, take a look at what happened to Australia this past week.
Yeah. I mean, you have to obviously look into it in context, which is that Asian yields, depending on which country you're looking at and which currency you're investing, those have fallen also relatively sharply over the last couple of years. I think value does still exist, but you're now having to struggle to find yields of, in US dollars, 4 or 5%, whereas a couple of years ago you would be able to get 7 or 8% for the same type of credit. However, I think that in Asia the story still remains pretty positive. Asia is a net beneficiary, with 1 or 2 exceptions, of lower oil prices, and I think that's going to have a big impact during the course of 2015, and I think we're seeing that in places like India already.